In today's video, I am going to be comparing SPY and QQQ, the differences and which one you might want to buy. So really quickly, what are the main differences? Well, QQQ is of course following the Nasdaq and SPY is of course following the S&P 500. Now there's other options for both of these types of ETFs, like for example SPY, the alternative is VOO, which I find is just a bit better. However, today let's get down and let's really check out the differences other than the fact that they're totally different markets that they are index funds for. So first off, QQQ, let's really check it out. So first off, it has a 0.5% of a yield. That's the dividend. And of course, when it comes to the yield, you're not buying this for the dividend. The dividend is kind of a nice bonus on top of it. What you are buying this ETF for is of course the growth. Nasdaq is a tech-heavy index, and that is what you are buying is the growth. The average volume for this ETF is 38 million shares traded every single day. So essentially what that does mean is it's going to be very easy to get in and out of. Now the expense ratio for this one is 0.2%, and at that point, for example, if you were to stick in $100 every single year, you would be then giving them, the company that runs QQQ, which is Invesco, you would be giving them 20 cents. Now, you're probably wondering, why do I need to give them this? It's because, of course, they are now managing your money if you invest in that ETF. From there, you want to look at the monthly beta, and it actually does just slightly better than the actual underlying stock index that it is actually following. Generally, you would want to see that at 1 or better when it comes to an index fund, and it is just slightly better. So that's always really nice to see. Now, again, what you are getting here is the growth. It is massive growth. This is ridiculous growth, however, from the bottom of the COVID pandemic stock declines to where it is today. This is absolutely insane. So you're going from about 170 all the way up to 350. You are basically doubling your money in about a year. And that is pretty crazy if you really think about it. Now, what are some things that we also see? Well, we see that there's quite a few dips in this. We see a dip here, we see a dip here. We see multiple dips, and this is why I always say to everybody, especially those who are new, you never want to say, oh my God, look at this. It's going crazy. We're gonna be going up to insanity. There's the rocket ship. We got the rocket. It's gonna be going to the moon. Well, guess what? Anytime that people are saying it's going to the moon, it's gonna fall. Believe me, anytime people say that, it's going to fall. And that's essentially what happened. And we've seen that with heavy volume. And this is a very easy way to trade. I teach this to everybody. I tell this to everybody. Anytime you see a sharp decline, anytime you see declines and you see heavier than normal volume, you are going to say, okay, well, let's start buying in slowly. So you start buying in slowly. This is what I always tell people, buy in slowly, buy in slowly. As soon as it starts to rebound, if you didn't invest all the money that you wanted to, still keep on buying slowly, because guess what? It's going to continue to go higher, and we see that over and over again. We also see that the stock market continues to ride higher, and this is what you're going to see with every single index. Now, this is why I say you can randomly just invest. When let's say you get a paycheck and you want to invest, let's say $300, for example, you can. Or if you've got a free trading account that allows you to do fractional shares, you can do fractional shares at $50 even. However, as soon as you start seeing lower volume and the price rocketing higher, that is euphoria. You have to wait. Believe me, you would want to wait, because as soon as it starts falling again with higher than normal volume, you can start buying in again, and believe me, you're going to make a killing. Right now, literally today that I'm recording this video, which is not the day that I recorded this stock price. Currently, the Dow Jones, this is Thursday, July 8th that I'm recording this video. And the stock market, the Dow Jones is down 400 points with high volume. This is the day you would want to buy in. So when do they do their dividend? Well, of course, they do their dividend every single quarter. So what we're seeing here, and I'll change the color because I want to. We're going to go from June to June. From June until June, we see a dividend lowering. Oh no, that's not good, is it? However, we do see from the previous quarters that the dividend actually rose. Why is that? Well, guess what? Because this is an index fund and it pays every single quarter, because maybe there's a few stocks that their quarters didn't line up with the quarterly dividend of this ETF, and that's why you'll sometimes see a little bit of a rise, a little bit of a lowering, and things like that. So always look over time. Yahoo is sometimes a great resource, sometimes it's not a great resource, considering that when we start looking at Canadian ETFs right now, Yahoo's kind of messed up. Now, the top 10 holdings of QQQ is, of course, number one is Apple. Apple is the largest company in the world. Microsoft, Amazon, Facebook, Alphabet. Alphabet is Google. Tesla. Tesla is amazing for the future, especially considering that the U.S. government is going to be really incentivizing people to get electric cars. And guess what? That's what Tesla does. But Tesla also does solar. It also does battery technology. It does power, electrical grid stuff. They do a ton. So, of course, that's a very smart stock. We've got Alphabet again. The difference between Alphabet and Alphabet is, of course, just literally they split a few years ago. Nvidia, PayPal, and Comcast, great holdings, all tech, however. Moving to SPY, VOO, and any of the others that really do follow the S&P 500. If you are more of a dividend type person like myself, you may like the dividend better. It is 1.3% versus 0.5%. It is literally almost 3 times higher. It's got way more volume as well, and of course, that doesn't include VOO. However, when it comes to volume, 66.8 million shares is pretty crazy. 0.9% is the expense ratio, which means that for every $100, of course, you're going to be giving them 9 cents, which is a lot less of an expense ratio. However, what you are looking at here is exactly following the index, so it's not going to be as great versus QQQ. However, if we look at the actual stock chart, you'll actually see that the S&P 500 hasn't had the same crazy growth over time. However, we are seeing a pretty good increase from about just over 225, 240, 230 in that range to 430. It hasn't doubled like it has with QQQ. However, you are still getting a very good long-term growth. And remember what I said, remember what I mentioned earlier. High volume, stocks go down. High volume, stock goes down. Guess what? Buy it all the way down. Every time you see it going down with high volume, it's time to buy. Never go in all in right here. Go small increments. Let's say you had $10,000 to spend. Go $2,500, $2,500, $2,500, $2,500. And guess what? You're all in, and you can ride that wave all the way up to the moon. Yeah, I said the moon. That's the rocket ship. And that's what I'm really talking about to most people. You don't have to go into a stock chart and say, it's got a double bottom, it's showing the flag, it's showing all this. That's great. If you know how to read charts, that's fantastic. But the most basic way to read a chart is very simple. If it's going down with high volume and it's an index fund, guess what? It's time to buy. It's super simple. You don't need anything special. And it does pay a dividend every single quarter as well, which is fantastic. Generally, you're going to see an increase in dividend while the actual stock market is increasing as well. So again, super simple to invest in. Both very easy. The holdings of the S&P 500 are also extremely tech-oriented because tech is a massive sector in the United States. If we ever have a 1999-2000 crash again, the stock market's going to be looking terrible. However, I don't see that happening. Apple, Microsoft, Amazon, Facebook, Alphabet are all massive, massive companies with massive, massive earnings, massive, massive followings. I don't see them crashing. Berkshire Hathaway is, of course, Warren Buffett's company, and they invest in companies as well, and that is basically an ETF all in its own. It's not an ETF, but in my opinion, it should be classified as one. JP Morgan, which is an amazing bank. Tesla, amazing, amazing stock. Doesn't pay a dividend, but it's great for future earnings. And Johnson & Johnson, of course, they have their vaccine that didn't work all that well. However, they have a lot of other things in the pipeline, and I think that they're still a solid company. So which one should you invest in? That is the hardest question. Personally, I think that everyone should invest in index funds, and I think that everyone should have at least their first $5,000 to $10,000 that they save into an index fund and just literally let it sit there until they retire. Because when you start looking at this stuff, it's very simple. The stock market will never go to zero. Of course, temporarily there'll be downturns and things like that, but overall it's not going to go to zero, and I probably just jinxed it. However, when we start looking at it, just whenever there's high volume and it decreases in an index fund, you buy in and then you ride it up higher. It's very simple investing, very easy. You don't have to know anything with these companies other than the fact that you're essentially investing in the entire massive biggest companies in the United States. I hope that this video has helped you. If it has, hit that like button and subscribe, and I'll see you guys again in my next video.